FDI is pretty interesting as a kind of upstream indicator and the patterns of trade and how trade is changing due to geopolitics, due to macroeconomics, etc. Let's look at FDI and look at what the signals are now in terms of where the FDI money is going, because it might tell us something about where trade goes next.
That's McKinsey partner Nick Leung. Historically, leaders have looked at foreign direct investment, or FDI, as just one of several variables that can help them understand the global economy. But McKinsey's latest research shows FDI really needs to be a priority. Nick joins me and senior partner Olivia White to get into it. This is the McKinsey podcast, where we help you make sense out of the world's toughest business challenges. I'm Roberta Fasaro, your host for today. Nick, Olivia, thanks so much for joining the podcast today.
Great to be here.
Thank you.
We're talking today about a recent MGI report on foreign direct investment. For many years, it seems as though FDI felt like this background economic variable. But for a CEO running a global business, now seems like they should be looking at FDI a little bit differently, maybe as more of a strategic signal and not a finance or government relations topic. Can you talk about why that is proving to be the case? Olivia, we'll start with you.
Sure. So effectively what seems to have happened over the past 3, 4, 5 years, perhaps not surprisingly, is on the one hand, foreign direct investment or cross-border. And we're talking about greenfield foreign direct investment, dollars that go towards new capacity for new production capacity or expanding production capacity. And we've seen that the money that's flowing has shifted in a really major way towards what we've called future-shaping industries, things like AI centrally, advanced manufacturing of many sorts, including EV and batteries, and also resources in the energy that support it. The dollar amounts have become bigger, so there are many more and bigger mega deals of $1 billion or $10 billion, or even in one specific instance, $100 billion, and they've become more geopolitically tied. And we believe that, first, you can read a bunch of competitive dynamics in what that flow looks like, but you can also see something about where trade and competition will be in the future, because a dollar announced today or that goes in the ground today tells you something about where things will be produced and who will be trading and who will be competitive in the future. And that's that future signal that leaders of businesses need to care about.
Nick, anything to add there?
The FDI is pretty interesting as a kind of upstream indicator and the patterns of trade and how trade is changing due to geopolitics, due to macroeconomics, etc. And so we said, well, why don't we go upstream? Let's look at FDI and look at what the signals are now in terms of where the FDI money is going, because it might tell us something about where trade goes next. If we'd done this pattern 15 years ago, we'd have seen all the money going into China, which created the manufacturing base, which then we had trade with China that followed. Right? It's a very similar thing. And now what we're seeing, of course, is that it's not focused necessarily on geographies. Of course, geographies are very important, but it's focused really on industries, on the future-shaping industries that Olivia just mentioned.
The report mentions that 3/4 of recent FDI announcements are actually going into these industries. What does this imply for CEOs who are maybe not already in the top tier of the global players in these future-shaping industries? How do they need to react?
Let me even broaden your question, because it also is a question about what does it mean for people who aren't directly bullseye in the industries that are getting more money. We would contend that it actually has implications for those players too, or at least potential implications that they might be looking at. A lot of investment actually ends up being in some important form place-based, like a big energy project or a mine, to create a big data center to power AI, computation or training, to create a manufacturing facility that various different players can plug into. So if I am building a factory, for example, there are all sorts of suppliers that will have to come into play. The demands even for things like hotels or food will shift. And so there's a range of considerations that people across industries, but also different sizes, can think about in that context. If you're looking at money that's going in the ground that your competitors are putting in the ground, you can start to say, well, gosh, look, do I have somebody who's a competitor that's building a bulkhead to produce in a new market where I sell or where I want to be selling? How do I want to respond? How do I think about that? And I can think about that both at the level of the investing company, but also for the full ecosystem. How's the ecosystem going to shift? What's that going to mean for my base of competitors?
The analysis we did essentially was looking at a period of time pre-COVID. So we look at the late teens, 2015 to 19, and then essentially from 2022 to 25, right? So we're looking at the old world and the current world. And the old world perhaps is characterized more by where things were done mattered less. The world is flat paradigm where, you've got a factory, put it wherever it's most economically convenient to do so, wherever you can get the possible lowest cost, lowest factor costs, highest efficiency. And that paradigm of the world being flat ignored where things were done. And I think what happened in the last few years, of course, is a far greater understanding of both the implications in terms of jobs, but also in terms of strategic implications. So it's geoeconomic in the sense that where things are made have a whole bunch of important strategic implications. People want to have, for example, battery manufacturing done work closer to where they're going to need those batteries, or people are going to want to have semiconductors in many more places than they have today. And this idea of where things are made has become so much more the focus.
What's the role of technology, perhaps, in all of this?
So technology has been a facilitator of where people want to trade for quite some time, and it was a core dynamic in what happened over the past, depending on how you think about it, 20, 30, 40 years that we were talking about, because it enabled people to decouple some of manufacturing activities from the design kinds of activities, from the software that powered the design, et cetera. So you could pick where you wanted to do the various different activities based on considerations of capability and cost and sort of broad productivity all in. And just to make that explicit, I could run a AutoCAD design program sitting wherever I wanted, at least in principle, use the way that I designed a given product, say an engine, but then have that engine manufactured somewhere where I thought the factory had high capability and the combination of labor costs and capital costs and energy costs, et cetera, were economically advantageous to me. Very much enabled by technology. Okay. Now where you say, well, gosh, I want to start to try and build something in a place where I haven't been building it before. Well, all of a sudden, I better think about, do I have the technological capabilities to do that? And on one hand, all right, now that technology has advanced, maybe it's easier to do it in more places. On the other hand, technology is not just a matter of theoretical know-how. It's a matter of a lot of practical and process know-how. So on the one hand, sort of open potential in new places, right? We talk about a 3D printer and allow me to print something anywhere. On the other hand, if there are factories in China that have immense know-how in how to produce specific things at very large scale, who's going to be able to replicate that at least as quickly and at the same front?
Technology is probably, the most, apart from the word where, I think the next most important word in this whole debate is indeed technology, because I think we're seeing the new world being built. When I say the new world, I mean the world which is around green tech, around AI data centers and what they require, around semiconductors and where they're made, right? I mean, this is where all the money is going. This is where everyone's attention is, both in terms of business as well as in terms of policymakers and politicians, right? All of these three things require massive amounts of new capital investment which should go into the ground. What FDI is showing us is how this world is being built and where it's being built. So if you look at, for example, green tech, you look at the amount of batteries that are being built everywhere, you're looking at new solar plants being built all around the world. These are very capital intensive enterprises, and these are big, big deals, right? And if you look at China's where inbound FDI is completely dried up because of all the economic difficulties China's faced over the last few years. We've seen that completely dry up. On the other hand, China is now exporting capital as it's trying to build some of this green tech infrastructure outside. And as there's a demand for that in many parts of the world. You look at semiconductors, of creating those ecosystems which are incredibly beneficial, but they're already very, very isolated at the moment. People are trying to do that. You look at these massive semiconductor announcements that have gone into building semiconductor capacity in the US. Right? That's a big, big driver. This is the future of the world that's being built, right? AI data centers announcements in the last year or so, they're dominated by these data centers because they're huge investments. They're made in places which make sense in terms of where the demand will be. This is the future. We're seeing it being built, and we're seeing it being built through these massive capital commitments that are being made globally.
Olivia, we've talked a little bit about the US, we've talked a little bit about China. And what about Europe?
Europe really is in a very equivocal place. On the one hand, actually, it's attracted more FDI. On the other hand, it's attracted a lot less, and the amount that it's attracting in future shaping industries is a lot less than that of North America, which is a clear signal, we think, of perceived competitiveness. And I'm looking at extracting intra-European investment here, just money into Europe from outside. And indeed, a lot of the investment that's come into Europe has been in green energy. Now, what does Europe need? Well, Europe to revitalize growth and productivity improvement, et cetera, to take advantage of potentially productivity enhancing technology, AI, very much needs both investment in those technologies as well as investment overall. So you see the sort of deficit of competitiveness, but you also do see not an insignificant amount of money going in, but it will take the sort of focus and reform measures and a host of other business-friendly steps.
Nick, did the data reveal any one particular sector, AI, data centers, semiconductors, batteries, energy, that would most dramatically reshape global trade?
Yeah, all the ones I mentioned are going to be huge. All of those are massive, and they're very intertwined in the sense that they all play together. You have an AI data center, you need green energy to supply it. You need all the semiconductors to actually make it work. They all come together, essentially, into many of these investments.
When we say they're all big, to give a sense just of how big and how we're seeing the future now, if you look at the dollars going into FDI projects in various geographies, and you say, well, what will that mean for increase in capacity in the future? If you look at FDI projects just since 2022, in the domain of battery production, they could more than quadruple manufacturing capability outside of China, but other countries are investing too. They could nearly double the data center capacity that powers AI across the world in places outside of the US and China. So huge increase in investment in those places. Or in the case of semiconductors, you can debate around it. If you look at leading edge semiconductors, basically the huge inflows of capital into the US could completely shift the balance of who leading edge semiconductor producers are, bringing the US into that circle. And that's why all three of these, plus the renewable energy, matter tremendously. Sometimes we say 10% is a big increase or 20% is a big increase, right? This is 400%, 200%. It's really big.
That's amazing. We talk about the importance of the where. It seems as though from the research that the U.S. appears to be a major beneficiary of recent FDI shifts. China has pivoted to become sort of a major outbound investor. How do you interpret this rebalancing? What lessons can CEOs draw from this pivot or this shift?
I don't think there's any great mystery buried in those numbers, right? Okay, so in the case of the US, there's a lot of question, right? Exactly what role is the US going to play? How are multinationals going to position themselves vis-a-vis the US? On the other hand, it really is very clear that the amount of money that's been promised into the US has gone up a lot. And it's gone up particularly in semiconductor manufacture and in certain areas, actually, of advanced manufacturing more broadly. People are not investing inbound in data center builds in the US, and that's because the biggest tech companies at this stage investing in AI data centers are American. The US is, at least in some form, very intent on figuring out how to develop manufacturing capabilities, at least in certain areas, and has, in various different ways, tried to attract money to it. And at the moment, that seems to be happening. And at least by our tracking, these projects are, for the most part, moving forward. And so everybody really does need to be thinking about what role they're going to be playing in the US market and what that means about the degree to which they're going to be manufacturing here. There are a lot of things that could go wrong. These things are not easy to do, particularly not easy to do in areas where you have either atrophied or just not developed capability. You need real development of human capital and skills, both specialized skills, but also specialized skills of a more sort of traditional sort, like welders. And it's a very big and rich market.
There's been a flow of money into the US market because of the recognition that over the long term, the US market has actually delivered better returns than any other market by quite considerable distance. Right? It's also created the bifurcation between GDP growth now in the US is so far from what it is in Japan or Europe, where it used to be quite similar. And so you also see this, it's a recognition of returns, I think. And similarly, the flip side of that is a recognition that in China today, particularly over the last few years, those returns haven't been as apparent as they were in the past. And so you've had, I think, a recalibration of the attractiveness of investment returns, which has also driven, I think, more money and more commitments to the US market. Not just the policy considerations, which Olivia outlined, which I think are obviously crucial, but also the fact that investors can justify those investments quite easily. So there's a kind of a situation where both policy and economics are telling the same story.
For countries and companies that want to make FDI work, you have to have certain capabilities. Were there any best practices that were revealed through the research?
We found that more often than not, when FDI was outsized, an industry grew, but more often than not, like 60% of the time. Okay, so like good chances, but not sure odds at all. And so we then said, okay, in those cases that were successful, what was different about them from the cases where the growth wasn't successful? And basically, we found a couple of factors that were crucial. So one was you had a human capital ecosystem that helped make sure that there were people on the ground who understood the technology, who could build out the technology, and then people who were trained more specifically, for example, to work in factories or in the ecosystems of suppliers around those factories. The second was domestic investment started to pile in too. And then the third thing is that this was happening in ways that allowed the industries to plug into global supply chains. So they weren't sort of toiling on their own to make things for a domestic or a narrow regional market, but were able to start selling into a broad global market.
I think many of them feel that relative to a few years ago, there is more uncertainty around more parameters today than before. And certainly if you look at, most recently, if you look at things like changes in tariffs, if you look at things like geopolitical realignment and potential further realignment. And so why is it that we've seen this huge shift towards future shaping industries? Because in the future shaping industries, you can't wait. I have to do this as a data center. I have to do this as semiconductors because a couple of years down the road, everything will have changed again, right? And if I don't do it now, I may be left completely behind.
At the end of the day, what are the top 3 messages that you would want CEOs to come away after reading this?
Things are happening today that will change the shape of the competitive and sort of geoeconomic future. And you can't sort of wait to ride out to see what that will be. 2, there's a set of industries in which that action needs to be at large scale to work. And it helps sort of set the scale for entry to play, which is different in different markets. And then I guess the third thing I would say is energy and resources still matter, right? The conventional seeds of FDI are still very, very much at play.
Nick, any messaging from your end?
Yes. The challenge that decision makers face today is that the very assumptions with which they go into a decision have shifted. Right? And so it's not just what you're looking at that's shifted, it's also the lens with which you look at it needs to also adapt to what's happening in the world. What are the assumptions that you've had for the last decade which are no longer valid?
Thank you. This has been a great conversation. Appreciate you taking the time, Nick, Olivia. Thanks again.
It was great, Roberta. Thank you.
Thank you, Roberta.
Thanks so much for listening to the McKinsey podcast. I'm Lucia Rahili.
And I'm Roberta Fasaro.
Find us on McKinsey.com. We'll have a transcript of this episode up shortly.
And download the McKinsey Insights app, where you can find this podcast and other helpful content updated daily.
If you enjoyed the show, we'd love for you to leave a rating and a review.
We'll see you in 2 weeks.